All right, let's jump right into this explainer. Today, we're untangling the incredibly wild rise and the totally devastating crash of the Siren token. It's a story that swept through the crypto world in early 2026, and man, it left a lot of broken portfolios in its wake. But more importantly, we're going to use this specific disaster to reveal the 7 cardinal rules every single crypto beginner absolutely must know, courtesy of some really great insights from CoinMarketCap.
So here's how we'll break this whole thing down. First, we'll look at the crypto Siren song. Second, we'll meet the Siren token itself. Third, the anatomy of a price pump. Fourth, that devastating 91% crash. Fifth, the whale trap rebound. And finally, surviving the crypto market. Let's get to it.
Section 1. The Crypto Siren Song and the Psychology of Beginner Traders.
Okay, so to understand why people lose money in crypto, we first have to look at the psychology of the beginner trader, right? It's all about that seductive trap of overnight wealth. Before we even talk about the token itself, we really have to talk about human nature. Because when a new bull run starts, the market feels like this unstoppable money-making machine. And honestly, that psychology is exactly what sets the trap. So the crucial point here is exactly what CoinMarketCap warns us about in their guide on common trading mistakes, the fatal first mistake. Mistake number 1 is treating the market like an overnight gold mine. They remind us that the whole getting rich quick thing, that really only happens to a tiny handful of lucky traders who enter right at the absolute beginning of a cycle. For everyone else, treating crypto as a lottery ticket is literally just a mathematical recipe for disaster.
It's that classic clash of expectation versus reality. You expect to be showered in coins, becoming a millionaire overnight during a massive bull run, but the reality is usually much, much darker. Without a proper exit plan, which, by the way, brings us right to CoinMarketCap's mistake number 2, you are likely going to lose more than half your capital in a matter of months. You see, when the market turns sour, beginners improvise, and improvising with your life savings while you're highly emotional is absolutely the last thing you want to do.
Section 2. Meet the Siren token, the ultimate shiny new object.
Now, what's really fascinating here is how the perfect, shiny new object came along in early 2025 to tempt these exact beginners. You know how in Greek mythology, sirens lured sailors to their doom with their enchanting voices? Well, in the crypto markets, this token did the exact same thing. Enter Siren. Launched on the BNB Smart Chain, it built this massive hype by branding itself under the banner of DeFi. That's the hot new convergence of decentralized finance and artificial intelligence. It marketed itself as literally the very first fully on-chain AI analyst agent. It promised to replace manual chart reading with an AI. It would scan thousands of tokens across multiple chains just to feed you perfect trading signals. Honestly, it was the absolute ultimate bait for a beginner who just didn't want to do the hard work of learning technical analysis.
And to make it even more appealing, Siren seduced retail investors by offering 2 distinct AI personalities to trade with. On one hand, you had the golden persona, which was branded as rational, data-driven, and hyper-focused on safe, steady growth. But on the flip side, you had the crimson persona, which was aggressive, high-risk, hunting microcap tokens and using high leverage. This dual persona gimmick was a total marketing masterclass, because it perfectly masked the underlying reality of the Siren token itself, an asset so wildly speculative that Mudrex actually rated it a C high risk, noting it was completely capable of violent 122% daily price swings.
Section 3. Anatomy of a price pump and falling for the hype.
So let's trace this timeline and see exactly how it built into an explosive price pump that caused beginners to make some truly terrible trading choices. The token launched pretty quietly back in February of 2025, but fast forward exactly 1 year to February 2026 and a massive supply burn happens, triggering this huge narrative around a supply shock. By March 22, 2026, the price simply skyrockets to an all-time high of $3.61. As news of the token burn hit the presses, retail traders violently FOMO'd in, and this perfectly highlights CoinMarketCap's mistake number 7, trying to trade the news. Because guys, by the time retail heard about the burn, the smart money had already priced it in. Just 2 days later, on March 24th, the devastating crash begins.
I mean, just think about a jaw-dropping 4,598% one-year return. Seeing that kind of number, novices completely lost their minds. They abandoned their own trading systems and constantly switched strategies, which is mistake number 6. And what's even worse, they blindly copy-traded crypto influencers right at the absolute top, which brings us to mistake number 5. They saw nothing but green candles and mistakenly assumed the line would just go up forever.
Section 4. The devastating 91% crash, when the rug gets pulled.
Well, when gravity finally kicked in on March 24th, It wasn't just a minor correction. It was an absolute massacre. In a matter of days, $846 million in market capitalization was completely wiped out. Gone. So why did it crash so incredibly hard? Well, on-chain sleuths like Bubble Maps and ZachXBT revealed a genuinely terrifying reality. A single entity, a connected cluster of about 200 wallets, controlled an astonishing 88% of the entire token supply. And the kicker? They acquired those tokens at an average cost of just 4.5 cents. So when retail was frantically buying at nearly $4, these insiders were quietly locking in an 8,400% return.
If you track the exchange net flow across this whole saga, you can see the exact trap being set. From November all the way to January, there's zero movement. The price is completely dormant. Then, look at February. A large negative flow leaves the exchanges, which creates artificial scarcity and pumps up the price. Then we hit that critical window of March 20th to the 23rd, right at the peak. A massive positive flow of over $1 million suddenly floods back on the exchanges. This is the smart money quietly depositing tokens to distribute and dump on retail beginners. And what fatal mistake did beginners make right here? CoinMarketCap's mistake number 3, taking oversized positions. Retail bought massive bags with high leverage right at the top, leading to brutal liquidations when that deeply negative crash hit in late March.
Section 5, the whale trap rebound, or the dead cat bounce.
Now, you might think the token was dead in the water after a 91% crash, but strangely, in mid-April, Siren suddenly jumped 150%. The catch? The asset had a towering $1.52 billion market cap, but a tiny, razor-thin liquidity depth of just 1.27%. This is a massive red flag. With liquidity that incredibly thin, whales can manipulate the price upward with astonishing ease. And this tricks beginners into CoinMarketCap's mistake number 4, forcing a trend reversal, basically believing the market just has to reverse eventually. Retail traders see a green candle after a devastating crash, they assume the bottom is safely in, and they try to catch a falling knife.
Arkham Intelligence actually caught the whales right in the act here. Sophisticated players use something called wallet splitting. If you're new to the term, this is when large holders deliberately break up their massive stash into hundreds of smaller, unlinked wallets. Why? To hide their tracks and fake organic trading volume. They routed over 8 million Siren tokens from Binance proxy wallets into coordinated addresses in just 6 days. Guys, they weren't holding, they were simulating demand. They artificially squeezed the retail traders who were shorting the token, basically trapping everyone in a highly manipulated dead cat bounce before ruthlessly resuming the sell-off.
Section 6, surviving the crypto market and the hard lessons learned.
Okay, let's pull all of this together to ensure you don't become the next victim of a DeFi disaster. The Siren story is really a perfect microcosm of everything that can go wrong if you lack discipline. By viewing the collapse through the lens of CoinMarketCap's 7 common mistakes, we can see exactly how a lack of discipline literally turns retail fish into whale food. Let's recap. Expecting overnight millions led to buying at the top. Having no plan meant no stop losses. Oversized positions led to brutal liquidations. Trying to force a reversal led to buying the fake bounce. Blindly following influencers gave whales their exit liquidity. Switching systems meant abandoning risk management entirely. And trying to trade the news, well, that meant buying the rumor long after the whales had already sold the fact.
So I want to leave you with this final thought today. In a market where a single cluster of wallets can control 88% of an asset and engineer an 8,000% return at your expense, are you trading with a hardened, disciplined plan, or are you just swimming against the tide hoping to get lucky? Seriously, keep this question at the absolute forefront of your mind the next time a shiny new token promises you the moon. Stay disciplined, trust the data, and stay vigilant out there.